let's move on to the other two ways to calculate the value of an index. The first is a valuated index. And the way this works is you calculate each individual stock's return. Then you multiply each stock's return by the stock's relative capital weight in the index. Remember, capital weight is the number of shares times the price per share. And so larger companies, which have a greater effect on the economy, are also going to have a greater effect on the index. So let's assume that stock 1's market cap is 14 million and stock 2's market cap is 30 million. The total value, or the total market cap of the index, is 44 million, and so stock 1 is only going to have a 31.8% effect on the index, whereas stock 2 is going to have a 68% effect on the index. It's over twice the size, and so therefore it has over twice the effect. And since each stock's return is multiplied by its weight in the index, stock 2 has a greater effect on the index because it is a larger company. For an equally weighted index, you start the same way. You calculate each individual stock's return, but then you just multiply it by 1 over the number of stocks in the index so that each stock has an equal weight. And so, for example, if we have a 2-stock equally weighted index, then each stock has a 50% effect on the index. And let's just go to some quick calculations. And so here is the spreadsheet we were looking at before. We're on the first tab, the index returns, and we're going to look at the returns to the price weighted, the value weighted, also called a market weighted, sometimes called a cap weighted index, and then we'll look at the equally weighted. So day 1, stock 1 is 70, stock 2 is 30, and we see that if stock 1 goes up by 10%, then it has a 7% effect on the index and the price weighted. But if instead stock 2 increases by 10%, it has a 3% increase on the index. For the value or market weighted, now we can see day 1, $70 and 30, day 2, 70 and 30. So stock 1 has increased by 10%. There's its return, but because its weight is smaller, it has a smaller effect on the index than the alternative day 2 when it's stock 2's price that increases. And so it's still a 10% increase, but here, because stock 2 has a larger market cap, 68.2%, it has a larger effect on the value of the index. And then finally, with the equal weighted index, you can see that regardless of which stock's price increases by 10%, both have the identical effect on the index, 5%. And so again, we have the 3 different indices. We have stock 1 and stock 2 on day 1, and then day 2, and then alternative day 2. On the first day 2, stock 1's price goes up by 10%. On the alternative day 2, stock 2's price goes up by 10%. And we see what the difference is going to be on the index. Here, the larger price has the greater effect. Here, the larger market cap has the greater effect. And here they have equal effect for an equally weighted index. Let's talk about the 3 different kinds of indices and how we might interpret them differently. First, a price-weighted index. There's not a lot of reason to still have a price-weighted index. The only benefit to a price-weighted index is that it's easiest to calculate. You just add up the prices and divide by the number of stocks in the index. And back in the late 1800s, when they first started doing this, it was easy to calculate the value of the index on a daily basis, and so that's why they came up with a price-weighted index. And there's no real benefit to it, and as far as I know, there are no new price-weighted indices. And the Dow Jones Industrial Average continues because of tradition, but because a stock with a larger nominal price has a greater effect on the index, which isn't really related to anything in terms of economic or how people invest, it doesn't make any sense to sort of calculate the value of an index that way. The Dow Jones Industrial Corporation sort of combats this goofy effect of a price-weighted index by requiring that new companies that are added to the index have a price that's within a specific range, which is why Apple split 7 for 1 at one point, so that it could get its price in a range where it might be attractive to the Dow Jones Industrial Average, and so that new stocks added don't have an outsized or undersized effect on the index. Okay, but let's talk about value and equally weighted index. So what's better? Which better measures the overall economy? Well, the value weighted index is going to have a better measure of the overall economy because companies that are larger and have a larger effect on the economy are going to have a larger effect on the index. An equally weighted index, sometimes people consider this to be more useful because this tends to be how people invest. So just because Apple is a larger company doesn't mean it's a larger portion of my investment portfolio. It may be over time, but initially I don't buy more of larger companies. And so equally weighted indices tend to reflect better what people's portfolios look like, and that's why they are popular. But obviously value weighted indices are what people mostly look at if the goal is to have some sort of proxy for what's going on in the economy. Just quickly, some of the goofy things associated with an equally weighted index. If you are rebalancing an equally weighted portfolio every year, then at the end of the year, any stock that's priced that went up, you're going to lower the weight, and any stock whose price went down, you're going to increase the weight to bring them back to equal weights. And so you are effectively selling winners and buying losers. And we need to think about what that means to be selling a portion of the stocks that have gone up and buying a portion of stocks that have gone down. How do momentum or reversals affect the return to a rebalanced index or a rebalanced fund if I am rebalancing? And the last thing is, what happens to an equally weighted portfolio over time if there is no rebalancing? Well, over long periods of time, stocks that have increased in value become, greater portions of the portfolio. And stocks that have decreased in value become smaller portions of the portfolio. And so over long periods of time, with no rebalancing, an equally weighted index will become a value weighted index.